Hello. Today's chapter 20, Accounting and Finance in International Business. Our learning objectives are the following. Discuss the national differences in accounting standards. Explain the implications of the rise of international accounting standards. Explain how accounting systems affect control systems within the multinational enterprise. Discuss how operating in different nations affects investment decisions within the multinational enterprise. Discuss the different financing options available to the foreign subsidiary of a multinational enterprise, and understand how money management in the international business can be used to minimize cash balances, transaction costs, and, of course, taxation. Understand the basic techniques for global money management. Introduction. Accounting is the language of business. It includes profit and loss statements, balance sheets, budgets, investment analysis, and tax analysis, the same exact things that we are doing in our simulation project. Financial management is predicated upon investment decisions about what activities to finance. Financing decisions about how to finance those activities. And money management decisions are decisions about how to manage the firm's financial resources most efficiently. There are national differences in accounting standards, and accounting standards are the rules of preparing financial statements, define what is useful accounting information. Auditing standards specify the rules of performing an audit. National differences in accounting and auditing standards can make it difficult to compare financial reports from one country to another. They're not on the same level playing field. The differences in standards include a general lack of comparability of financial reports from one country to another. The differences now matter more because of development of global capital markets and corresponding growth in transnational financial reporting. And then we've got transnational financing and transnational investment. The benefits for international accounting standards. Global providers of capital are demanding consistency in reporting of financial results, and the adoption of common accounting standards will facilitate the development of global capital markets. And there are several different types of international accounting standards. There's the International Accounting Standards Board, the IASB, the International Financial Reporting Standards, IFRS. Compliance is voluntary, but has developed accounting standards for firms seeking stock listings in global markets. If you want financial investors to purchase your stock, you better make sure that they can understand your financial statements and that they're not confusing, and that you have generally acceptable accounting practices, which GAAP stands for. The European Union mandated harmonization of accounting principles of the member states of the EU. Accounting aspects of control systems. You have a control process, so the head office and subunit management jointly determine subunit goals for the coming year. Throughout the year, the head office monitors subunit performance against the agreed upon goals. If a subunit fails to achieve its goals, the head office intervenes in the subunit to learn why the shortfall occurred, taking corrective action when appropriate. The accounting process assumes a critical role. Most goals for subunits are expressed in financial terms. The budget is the main instrument of financial control, and the subsidiary's profits and return on investment, or ROI. Exchange rate changes and control systems. The Lessard-Lagrange model. 3 exchange rates can be used to translate foreign currencies into the corporate currency: the initial rate, the projected rate, and the ending rate. Internal forward rate refers to a company-generated forecast of the future spot rates. So here's a possible combination of exchange rates in the control process. This rate is used to translate actual performance for comparison budgets. So you have budget at initial, actual at initial, budget at projected, actual at projected, budget at ending, actual at initial. And you can see how this works. Transfer pricing and control systems. How should goods and services transferred between subsidiary companies in a multinational firm be priced? The price at which goods are transferred is the transfer price. International businesses often manipulate transfer prices to minimize their worldwide tax liability, minimize import duties, and avoid government restrictions on capital flows. Separation of subsidiary and manager performance. It may not be appropriate to use ROI for comparing and evaluating the managers of different subsidiaries. The evaluation of a subsidiary should be kept separate from the evaluation of its manager. Manager's evaluation should consider how hostile or benign the country environment is. Managers should be evaluated in local currency terms after necessary allowances, which include tax rates, inflation rates, exchange rates, etc. Financial management, the investment decision. Capital budgeting. It's used to quantify the benefits, costs, and risks of an investment. It enables managers to compare different investment alternatives within and across countries. It's complex and an imperfect process. The capital budgeting process. You estimate the cash flows associated with the project over time. Once the cash flows have been estimated, they must be discounted to determine their net present value using an appropriate discount rate. If the net present value of the discounted cash flows is greater than zero, the firm should go ahead with the project. Project and parent cash flows. The project may not be able to remit all its cash flows to the parent. Cash flows may be blocked from repatriation by the host country government. Cash flows also may be taxed at an unfavorable rate, and the host government may require that a certain percentage of the cash flows generated from the project be reinvested within the host nation. Adjusting for political and economic risk. Here's political risk. Political change may result in the expropriation of foreign firms' assets. Political and social unrest may also result in economic collapse, which can render a firm's assets worthless. It may result in increased tax rates, the imposition of exchange controls that limit or block a subsidiary's ability to remit earnings to its parent company, and the imposition of price controls and government interference in existing contracts. And also, we cannot know political risks for certain. Economic risk. The biggest problem arising from mismanagement has been inflation. Studies have shown a long-run relationship between a country's relative inflation rate and changes in exchange rates. However, this relationship is not totally reliable. Risk and capital budgeting. It can treat all risk as a single problem by increasing the discount rate applicable to foreign projects in countries where political and economic risks are perceived as high. It may penalize early cash flows too heavily and not penalize distant cash flows enough. And you can revise future cash flows from the project downward to reflect the possibility of adverse political or economic changes sometime in the future. How will foreign investment be financed? Use global capital markets or borrow from sources in the host country. The cost of capital is typically lower in the global capital market, but host country government restrictions may rule out this option. Some governments court foreign investment by offering foreign firms low-interest loans, lowering the cost of capital, also known as local debt financing. Minimizing cash balances. This is what you do for financial management, also known as global money management. Firms generally prefer to hold cash balances at a centralized depository for three reasons. Number one, the firm can deposit larger amounts. Number two, if the centralized depository is in a major financial center, it should have access to information about good short-term investment opportunities that the typical foreign subsidiary would lack. The firm can reduce the total size of the cash pool it must hold in highly liquid accounts. Reducing transaction costs, commissions to foreign exchange dealers, various costs of exchange. The transfer fee, bank charge for moving cash from one location to another. Bilateral netting, settlement in which the amount one subsidiary owes another can be canceled by the debt the second subsidiary owes the first. Multilateral netting is a technique used to reduce the number of transactions between subsidiaries of the firm. This is a chart of the cash flows before multilateral netting. cash flows after multilateral netting. It's a lot cleaner. Managing the tax burden. Double taxation in some countries is mitigated by a tax credit, a tax treaty, or the deferral principle. Tax havens can help minimize tax liability. International businesses avoid or defer income taxes by establishing a wholly owned, non-operating subsidiary in the tax haven. Moving money across borders. You have dividend remittances, most common method by which firms transfer funds from foreign subsidiaries to the parent company. Dividend policy typically varies with each subsidiary depending on tax regulations, foreign exchange risk, the age of the subsidiary, and the extent of local equity participation. Royalty payments and fees. Remuneration paid to owners of technology, patents, or trade names for use of that technology or right to manufacture and/or sell products under those patents or trade names. Management fees and technical assistance fees are also included with that. Sorry about that word. Moving money across borders continued, we have something called transfer prices. Firms can reduce tax liabilities by using transfer prices to shift earnings. Firms can move funds out of a country where significant currency devaluation is expected. Firm can move funds from a subsidiary to the parent company or tax haven when financial transfers in form of dividends are restricted or blocked by host country government policies. The firm can use to reduce import duties when ad valorem tariff is in force. Fronting loans. Loans between a parent and its subsidiary channel through a financial intermediary, usually a large international bank. And you can sometimes circumvent host country restrictions and can also provide tax advantages. Then we have unbundling. Unbundling is the mix of techniques to transfer funds across borders. Here is an example of the tax aspects of fronting a loan. So you have a London bank, okay, it pays 8% tax-free, you have a tax haven subsidiary, and you deposit $1 million. Then you make a $1 million loan to the foreign operating subsidiary, and it pays 9% interest, which is tax deductible back to the bank. And this is how the bank makes its money. The 360 view, the impact of the macro environment, we show that differences in national regulations regarding accounting standards and tax policy can impact the financial reporting practices and money management policies of multinational corporations. The harmonization of accounting standards will continue to improve over time, and multinationals have an incentive to consolidate earnings in locations where corporate tax rates are low. I thank you for listening.